Hi, everybody. Barry McGuire here for Barry McGuire's Creative Real Estate Education Group. It's the Monday main event. We always gather on Mondays, 5 p.m. Mountain Time, to talk about creative real estate. My wife Dawn and I love creative real estate. We teach focus workshops on same. We just finished a very successful and brand new wholesaling workshop in Calgary about a month ago. And 2 weeks ago, we were in Toronto doing an agreement for sale, an AFS focus workshop, because Toronto and Ontario have decided they are ready to talk about agreements for sale. And I knew that to be the case because I had 5 lawyers show up as students saying, teach us about agreements for sale. We're getting inquiries. So creative real estate remains alive and well across the country. Next event coming up is the famous Rapid Cash program here in Edmonton. That's May 27th and 28th. There should be some information in the chat about that. But for today, we have a return engagement with Garth Chapman and Neil Shopsowitz on. We're going to talk about CMHC and MIL financing. Garth and Neil are whiz-bang mortgage brokers, commercial mortgage brokers. They understand commercial financing incredibly well. They work very hard on their files. They continually improve their knowledge and process, and we're very fortunate to have them in here today to do a return engagement on CMHC MIL financing, which we heard about some months ago. And now we're going to get a closer look at it, update some of the things we heard about before, get some tales from the trenches on stumbling blocks in this kind of financing. And in general, just increase our knowledge on this brand new CMHC program. So without any further ado, let's bring in our guests, and we'll have some conversation. Garth having a glass of water to get his vocal cords tuned up there. Hey, Garth.
Hi, Barry. How are you?
Good. Thank you very much. I'm doing well. And Neil, you always look so calm. I don't know if that's covering a roiling heart or not, but you do look calm. So that's good.
It's all
in our business. So, guys, we had a great session last time on CMHC ML financing. We talked about a lot of things that it was very well received. We got a lot of inquiries, and we're back again today. Garth, why don't you give us the kind of the summary of what we're going to talk about today and how we're going to update and improve on what you told us about last time.
All right, let's do that. So, by the way, Neil is a very calm guy. And that's a big plus when you do what he does. I've seen it in action. It's very helpful because I can be less calm when things get, tough. So we're both good at dealing with tough things, but we do it in a very different way. So I just want to say again, thank you for having us both on. We do enjoy this, Barry. You're such a wonderful host and a moderator. You make it really easy. We give Barry a few little wee notes, and he turns it into an hour of wonderful conversation. So the first talk we did was just you and I, Barry, and that was in would have been March of 2022 when MLI Select was being launched. And then Neil and I and you together did one, I think it was December the 12th. And here we are, April the 17th, and a lot has happened. So today we're going to talk about construction financing. We're going to talk about purchase financing. We're going to talk about refinancing. We'll have a few little general things to cover as well. And then we're going to do a couple of tales from the financial trenches. And I'm so delighted that you've allowed us to use your phrase, Barry. That's awesome, because it's really well known.
Yes, people say to me when I meet them, they go, "Tales from the trenches." I love tales from the trenches. So before we get started, just tell folks, when did CMHC put the MLI program into effect? When did that start? So how long have we been working on this?
This is a year and 1 month. So it was 13 months ago in March of last year.
Pretty new. Okay,
Yeah,
let's hit it, Garth.
All right. So Neil, and maybe, we should do a little introduction of Neil for those who don't know him and maybe weren't in the last call. You can do that. Neil can do that, whatever we like.
Well, let's have Neil tell us a bit about himself, and then Garth, I want you to tell folks about yourself because you have a very interesting story as well. So, Neil, tell folks how the heck you get to be the comm guy in the commercial financing trenches here.
I've been doing it for a long time. I've been doing commercial financing, commercial brokering for about 17 years now. I have a pretty varied background from before that, and it's probably too much to get into, but I started out life as a real estate lawyer, which in Ontario, which is very helpful with this.
Yes. So you're a recovering lawyer, as they say, kind of.
That's right. I saw the light early.
Yeah, well, some of us never see that light, Neil, so good for you on that point. That's a really quick summary of a pretty varied and wonderful career that you have, but that's fine. Garth, what do you want to tell people about you?
Yeah, lots of your people know about me. I just want to add a little bit that as I peel the onion that is Neil, I'm learning the things that he's done over the last several decades. He's had a varied group of careers, all mashed into one life. And his background, I understand now how he handles things and understands things the way he does because of his background. And someday he should write a book. I think it'd be a fun book. He's got some great stories. So me, I'm a reformed real estate investor. I'm on the passive end of things now. I have had, this is my 5th career. I don't intend to ever retire because I like what I'm doing. And we still hold a few properties. And I think the joy I get in this is just in helping people to do in real estate what they need to do. And the phrase I use is, my job is to help you get your version of my life via real estate investing.
Gotcha.
So
it's all right.
To construction financing, if we want to, because we're
Sure.
Barry runs a tight ship. We're only good for 60 minutes and we're 3.5 minutes in already. So maybe Neil, we could talk a little about construction financing, just the highlights. What are people running into? And we're doing quite a bit of this now. It's a great model to allow one to build a property and have the financing, both for the construction financing and the takeout completion mortgage, all under the same umbrella, under the COI, the certificate of insurance that we get from CMHC. That covers both the construction financing and the takeout financing.
Sure. I know last time we went through, I think, construction financing in detail. I'm just going to cover some points that have come up since then, and just some things to watch for if you're looking at construction financing. And these are in no particular order. First thing, choosing a contractor. So when you're looking at a contractor for any of these projects, you want to find somebody who has got some experience beyond building houses. It's quite important when the deal is submitted that you show CMHC and then ultimately the approved lender as well who the project team is, what the experience of the contractor is, what they've done. If they've never done this before, it'll be problematic. Second thing, most of the loans, construction loans, because of what's happened in the last couple of years with inflation, CMHC is insistent that at least 65% of the subcontracts are fixed price contracts. So, doing something on like just a straight cost plus without it being tied down will not fly. Most of the construction that we're looking at, and that's really our sweet spot, are projects that are kind of in that $2 to $5 million range. and they're big loans, but in lender world, they are considered to be small loans, and there's a fairly limited pool of lenders who will do these on an insured basis. If it's uninsured, there's more, but on an insured basis, because the amount of work that the lenders have to do for these, we're looking at maybe 3 or 4 lenders maximum who will look at these, and under $1 million, I just don't think we can do them at all. I just won't get anybody who will finance them. So we would have to go back to conventional lending and then look at insured lending for the takeout. I know there's small loans, and the last thing you want to do, or relatively small loans, is get involved in having to get bonding, which is a big expense and can add quite a bit to the cost. CMHC will allow bonding to be waived. What the insured lender or the approved lender will have to do is you'll have to get a quantity surveyor to do a report, confirming both the accuracy of the pricing and also the ability of the subtrades to be able to complete the contract. And once that report is done, and if it's done to the satisfaction of the approved lender and CMHC, then we can get bonding waived. To get a quantity surveyor is an expense. It will cost to get a report probably somewhere between $7,000 and $9,000 for an initial report, and then they will have to approve every draw, which will be another $800 or $900 per draw. But there's just no way around it.
Compared to bonding, what about the quantity surveyor route compared to the cost of bonding? Is a quantity surveyor much less than the cost of a bond?
A bond, like on a $1.4 million, $1.5 million contract, a bonding will be probably $35,000 to $40,000.
Oh, okay, so a big difference.
Yeah, and it also, requiring bonding may knock out some contractors or subtrades because they may not be able to be bonded. So that's another issue.
So if a borrower is able to accomplish some diligence on contractor and subtrades, that's obviously going to be a big issue. A reliable contractor and reliable subs are going to be very important to the report of the quantity surveyor.
There will be. The other thing that the approved lender will have to do as well is they will have to do credit checks, corporate credit checks on all the subtrades. And major subtrades and on the contractor, and those will have to be satisfactory as well.
Neil, I see we've got a question here. Barry, I know that Donna's not here, so I'll keep my eye open, but I see a question from someone. What is bonding?
Bonding is basically insurance. It ensures that the contract price will be met. I guess is probably the simplest way to put it. I mean, there've been so many bad experiences in the construction world where things end up costing 20-25% more. So it's basically like an insurance contract guaranteeing that your contract will be met at the price that it's quoted at.
There's another bond question. Does there have to be bonding on all the subtrades or the big ones like mechanical and electrical?
Just the big. Well, if you had to get bonding, it would have to be on the big ones.
Okay.
Like mechanical, electrical, plumbing, HVAC.
Okay. All right. Well, that's an interesting requirement and a big difference in the pricing for those two things. So not something that most folks run into, and really good to know. Bonding, RPA, bonding surveyor.
Yeah, but you really want to avoid bonding because, as I say, it's expensive. And it will knock out the pool of trades that you can use.
Yeah.
So a quantity surveyor, basically, for people who've never dealt with one, and I'm sure most people haven't, is they're basically a consultant, an independent consultant who will take a look at all the quotes, take a look at the at the trades, and then they'll issue a report, saying yes, we believe this can be done at the prices and at the budget that's been put forward, or they may say we don't believe it can be done.
Yeah.
Right.
it's quite a skill set that a quantity surveyor would have to have in order to make these determinations. As we look at what the requirements are, I can see there being a list of quantity surveyors that are acceptable to CMHC and or the lenders, and likely a smaller pool of these people available. And in busy times, it might be tough getting somebody to work on your matter. And just thoughts I'm having. I don't know.
I mean, I would line one up, at probably at the time that you submit to CMHC or shortly after. And again, it depends on the market. Like in a major market like Calgary or Edmonton, there's a fairly large pool of people that you can use. In smaller markets, you may have to bring somebody in from a major market to do it.
Yeah, makes sense.
Okay. Another thing, again, in theory on MLI Select, you can get up to 95% loan to cost, but your loan amount is always going to be limited by what the operating pro forma is going to look like at the end. All CMHC insured loans, well, really all multi-residential loans or all commercial loans, at the end of the day, are going to be based on what the projected or actual net operating income is, plus a buffer. So MLI Select, what makes MLI Select so attractive is that the buffer for MLI Select is 1.1, which means that your debt payments have to exceed your net operating income by a factor of 10% or more. Whereas in regular CMHC, it's 30%. And for most conventional financing, it's 25 to 30%.
Yeah, big difference.
But still, at the end of the day, the pro forma has to work. So what we're finding in reality is that typically these loans are going out at about 85 to 90% loan to cost.
Okay.
I've yet to do one at 95%.
Yeah.
Well, we have one submitted right now, Neil, that is at 95%. We just submitted.
No, I had to make some adjustments in the end.
Oh, did you?
Down.
Sorry.
We were close.
It's just over 90.
Okay.
Yeah, there were a few things that came up at the end.
Okay.
Yeah, the other thing also is we have to use a qualifying rate when we submit these. And if you asked me a month and a half ago, I'd say the qualifying rate would be 5% based on what was happening in the bond market. If you asked me 2 weeks ago, I'd say we could use 4.5%. If you asked me today, I'd say we're back to 5% again.
Yeah, up and down.
And after tomorrow's inflation report, who knows?
Yeah.
Mm-hmm.
Okay.
So in determining the maximum loan amount, Neil runs his magic calculator, and knowing the maybe easier for Neil to explain that, but it's really important that if you've got a project you've got in mind, that you as an investor can produce a pro forma. And one of the questions that we get often from new investors is, do you have a pro forma template you can give me? And my answer is no. But that is something that within this community, it would be great if there's a good example out there that someone would share those with investors. But ultimately, a pro forma is an expression of the projected financial performance of the asset in terms of rent, vacancy allowance, and then all the expenses that are known and the allowances for expenses that are unknown, and a resulting bottom line, which is the net operating income, against which you'll apply a loan and make payments and have some left over. So that's it's something we do very quickly, whether it's a new build or an existing asset, a refinance or a purchase. We can turn those numbers around. If you give us a pro forma and a little bit more in the case of existing assets, we'll turn that around within a day generally. Neil, any more you want to add to that regarding construction financing?
The only other thing, and again, I think there's a bit of a misconception on this. There is no lender's fee on MLI Select financing, at the end, when the takeout loan is done, or if you were doing a purchase or a refinance, there's no lender's fee. On construction financing, there would be a lender's fee, typically around 1% of the loan amount, unless it's a really big loan. But there is no lender's fee on the takeout. So when you're putting your budget together, I mean, I can help with that. And, usually when somebody sends me their budget, I help with the financing expenses, but that is an expense that needs to be accounted for.
Okay. Well, that's good to know, because differing loans have differing differing costs, and sometimes I look at them and go, "Whoa, this one, adding up, we now have a 9% loan that's coming in at 16.7." So it's good to hear that there isn't that kind of fee.
Yeah. So maybe the next thing we should quickly cover, and I want to be conscious of time. We're 21 minutes in. So in new construction, there's need for a construction budget that must be in an acceptable format. Experienced builders will generally have those. They will provide that to the client. Client will provide it to us. Neil will check it and make sure it's acceptable. If there are things that need to be added or changed, he'll advise. We recently had a couple of clients where their builder was acceptable but did not have the construction budget format. So we produced a template for that we can use going forward for situations like that. It's a pretty complex process, and we will help you through that. But it does take a little time and work to get that built and verified. And then of course the other side is, there's the need for an operating pro forma projection, which I talked about a minute ago. So those are the two keys. What's it going to cost to get this thing built, plus the land, plus your soft costs, and we can advise regarding soft costs, roughly what to expect. And then what's the property going to produce by way of income and net operating income at the end of the day, and that'll determine what it will support in terms of a mortgage, whether it's MLI Select, regular CMHC, or conventional. The formulas are a little different, but the process is the same in all cases.
Yeah. Numbers.
And one last thing. Your builder may have his own form of contract that he wants you to sign, but CMHC and the approved lenders will require all contracts with builders to be on a CCDC form, which is Canadian Construction Document Committee. And any of them can have access to it. There's a small fee for them having to register to be able to get the forms, and the forms are fairly self-explanatory.
That's an important thing to know. You put a lot of work into producing a contract that is rejected, so we may as well start with the right one.
And some of these things are things that some of these smaller builders won't recognize. They won't know. No. So it's important to get us involved early. Don't do your whole deal with your builder and then come to us and find out it's not acceptable in this form and that form, etc. So it's get to your broker early is what I would say coming out of that.
And isn't that an important point? No matter what, get to your broker, get to Neil, get to Garth early, because there's a lot going on here. There's a lot going on, and if you've got experience, great. But if you don't, you will suffer greatly by bumbling along on your own, talking to these gentlemen later than you should, and being politely told that you pretty much have to redo everything. So got to do it early.
Last thing on construction financing, we should use the term. So everybody's familiar with the term loan to value. So it's the percentage that the loan represents as a percentage of the value of the property. In construction financing, it's loan to cost. And you cannot get loan to value if value is higher than cost. It's always the lower of loan to value, or in this case, loan to cost, or appraisal. So if the appraisal comes in lower than the cost, then the mortgage is related to the lower figure of the two. Now there are ways to build something when you've got a way to build something really, really inexpensively. And we talked to somebody today who has that, somebody you know well, Barry. They might want to finance that construction and get it done. And I think Neil can tell us, but I think they have to hold the property for a period of time before they can do the refinance after it's an operating asset. And before they can do a refinance into MLI Select, and then capture loan to value and therefore finance on the lift. There's a couple of considerations there. One, I think there's a time period they've got to hold the asset, and the other is the equity takeout or ETO rule. Neil, can you speak to those?
Well, usually you got to hold it a year. Would be especially if you're creating additional value. The equity takeout rule used to be that like CMHC didn't care. Basically, if you bought a property for $1 million and you were able to do some cosmetic work or minor repairs, increase the rents, and get the value up to $1.7 million or $1.8 million, and then go and refinance it with a CMHC loan and take out the extra money. They didn't care. You could do whatever you wanted with it. They cracked down on that when rates were really low, and people were able to go out and refinance for a lot more just based on the rates and nothing else. So pretty much if you are taking out additional equity that you've created in the property, that money's got to go into. You can reimburse yourself for any repairs that you did on that property. Any other funds have to go into other multi-unit buildings or to purchase multi-unit buildings. You can't just take it out and put it in your pocket.
Interesting.
So consider that your investment in the asset, whether it's a purchase, a new build, or a refinance into MLI Select or into CMHC Standard, consider that money as locked into that asset unless you refinance and take the extra and reinvest it in another asset or in that asset to do renovations, for example. So you've really committed your initial capital to being locked into real estate. And if you refinance and you're kind of playing on the house's money and you take out some extra money, as long as you reinvest it, that's okay. And of course, there are an awful lot of investors who do that over time, regularly, and that's how they build their portfolios. Essentially, they make one investment and double up on it, so to speak, multiple times. So with that, we're 28 minutes in. We got 32 to go, and we're a quarter of the way through, so we'll probably want to speed it up. On purchases, Neil, what do you want to cover? What are the things that we've run into over the last year that are important for people to know?
Okay, well, I'd say the first thing, people see a property, they're really interested, they'd like to buy it. We look at their application and we're not sure they can because they don't have the means to come up with the down payment, or once they've come up with the down payment, they're not going to have sufficient net worth to support a guarantee. So, I think it's important to make sure that you're looking at properties that you can afford. One thing we can do is we can take an application from somebody, fairly early on and do an evaluation and say, okay, you're okay to buy, a property for $1 million or $2 million or $5 million, or you can buy 10 properties. But I think it's better to know up front than to go out and try and get something under contract and be frustrated.
No, for sure.
Yeah, I think the thing I would add to that, and we're happy to do that, we have a very simple one-page application. If you own existing properties, we have another spreadsheet that you detail the information on those, and we can evaluate that very quickly, as Neil said. At the end of the day, people can go onto the CMHC website and read all the rules about, this needs to be loan to value, debt, net worth. You got to have 25% of the mortgage amount as net worth. And how people define net worth and how CMHC defines net worth is different. So certain things don't count. Vehicles don't count. Household assets don't count. registered investments, RRSPs, etc., they're discounted. So, make it easy, bring it to us. We'll tell you what works, what you qualify for, because we've got to manage all of these other requirements that are a little less obvious than simple, what's the down payment going to be. So future rent increases, Neil, when we're seeing realtor pro formas these days, there's current rents and expenses and a net operating income figure. And then to the right of that, beside it is another column, and it's identical, except the rents are higher and some of the expenses might be lower. And that's the projected net operating income of the property. And you can't finance on what is projected. Sellers want to sell their assets based on the value at the on an as improved basis with a better NOI, better rents, etc. But the truth is you can only finance on current value. So we should, make sure people understand that, and then talk a little about, there are a couple of methods available to acquire an asset based on current operating pro forma financing, and then improve it and then refinance it. So there's three different ways to do that. We may not have time to talk about this in detail, but those are things worth talking about if you're of a mind to do that.
Yeah, I mean, one thing, okay, so this one thing I think is important is you're looking at MLI Select, and we'll use Edmonton because Edmonton's a good example. So let's say you want to do it on the affordability criteria, and you want to purchase an existing building, and you see all the rents are between $900 and $1,100 a month, and you know that the median, we'll tell you the median renter income for Edmonton, 30% to meet the affordability criteria is about, I think, currently $1,630 a month. So say, okay, well, I've got lots of room to raise rents. I'll do it under the affordability criteria, and depending on what level of points you want to get, I'll do it at either 40%, 60%, or 80%. But it would look like I have lots of room to raise my rents and still stay within the affordability criteria. It doesn't quite work like that. If you decide, let's say, that you're going to go for level 2 and 60% of your units are going to be at 30% of median renter income, when the application is submitted, a rent roll is submitted, and that forms the baseline for rents going forward. And those 60% of the units are going to be limited to what you're allowed to raise your rents by, your certificate of insurance and your social outcome contract with CMHC. And in provinces where there's rent control legislation, it's easy because then you're limited to whatever the rent control amount is each year. In provinces where there aren't rent control, like Alberta, you're limited to CPI. So that 40% or 60% or 80% of the units, whatever the baseline is when you start, you're only going to be able to raise the rents on those units or that pool of units by, currently I think it's 5.9% or 6.2% per year. So you won't be able to get those units to the ones that are subject to the affordability criteria to the 30% median renter income.
That's a very interesting point. Yeah, you have less room than you think as you look at some of these restrictions and rules. Equity takeout, this one, these are good things to know.
I think the other thing, and I don't think we have time to really talk about this in any detail. The minute we try to, it takes too long. But there is an opportunity where you have a willing seller and a good, sharp realtor to have the seller raise the rents. And as long as the rent increases are accepted by the tenants and they take effect within 60 days of the closing, you can finance based on those higher rents. So the seller's happy because he got a better price for his asset. The buyer's happy because they got a bigger mortgage. The risks are pretty limited. There are some, but that is something that I would say to folks, if you want to pursue that, then, send us an email. and get in contact, and we'll take it from there. It's something that has not been done for quite a number of years, but we're seeing it start to reappear.
Okay, good one.
All right. For most people, just on, affordability on purchases is generally the only criteria you can match, because it's very difficult to do energy efficiency on an older building, and most older buildings aren't going to work for accessibility. But you can get the maximum amount of financing in theory up to 95%, even if you do the 40% rather than 80% on a purchase. What changes is your maximum amortization. Since most buildings are built in the 60s and the 70s and the 80s on a purchase, you're not likely to get more than a 35 or 40-year amortization anyway, based on the remaining economic life of the building. So there's really no benefit to committing to do 60% or 80% of the units, because you're not going to get a 50-year amortization in any event.
So just a little sidebar here, folks, as Neil talks about some of the MLI factors, accessibility, affordability, etc. We discussed those in much more detail in our previous encounter, and that was in, I think, December of last year. So if you want to look at YouTube and find that one, you can get more detail on some of those criteria that we are not talking about today, particularly.
That's a great point, Barry. December 12th, I think it was.
December 12th, okay.
Yeah.
2022.
So on refinances, just a quick thing. There was a question I saw that we didn't cover. Is the cost of land included in calculating the total cost on a new build? And yet the answer is yes. And all of your soft costs. So all of your costs to, architect, to get, your development permit, building permit, all that stuff and more that you might imagine is included. Your cost of holding the asset while you're doing all of that work, all those sorts of things are included in your costs. A number of them are what we call soft costs.
And your equity in the land is included in your equity into the project.
Right.
Okay.
So often, in a major center in Western Canada, if you are buying a lot, maybe with a house, maybe it's a tear down on it. If you got yourself a line of credit and you were 50% in to the cost of that lot, that might be all you need to build a $2 million eightplex. You may have already got all your equity in. And if you have more in than you need, then on the first draw of the draw mortgage, you get that back. So you're pinned at your max.
Okay.
So refinances really quickly. We have the equity takeout rule that we spoke about earlier, and your planned use of funds. And really the other point I've got is, if you want to refinance your building, talk to us early and we will give you the list of what you need to prepare. And if you can provide us with your financials, we'll tell you what sort of a mortgage the asset will support. If we think you're missing an opportunity or two where you could bump that up and take a little bit of time and change this and fix that, you can improve that mortgage amount, and we'll get your ducks in a row, and then you've just got to determine how you're going to handle the excess capital that's coming out in terms of CMHC's ETO rule. I think, anything else on that, Neil?
Nope.
How about, Neil, this has come up pretty often recently, 5 and 10-year rate terms, pros and cons, because the 5-year and the 10-year rate are almost the same, which is unusual. And it presents, some people with a bit of a dilemma, which way to go. What are your thoughts there?
Yeah, I mean, it is very unusual. Usually there's about a half a point to 60 basis point difference between the 10-year rate and the 5-year rate. Reason to get a 10-year rate, if you weren't doing MLI Select, you can qualify at a 1.2 debt cover instead of a 1.3 debt cover, which means 20% coverage on your payments over income instead of 30%. So you can get a larger mortgage. If rates were lower, I would for sure, say you might want to think about a 10-year rate. The negative is that these loans are really closed. To get out of them is very expensive, and it doesn't really matter if rates go up or go down. What happens once the loans are closed, these mortgages get securitized into a pool at a spread, and so let's say it's a $2 million loan. The spread is probably about 85 basis points, 90 basis points. So if you were 3 years into it and you decided you wanted to sell the property, you would have to pay full yield maintenance for the balance of the term, which is 7 years. There's a slight discount for present value, but it doesn't make much of a difference. I mean, if the loan's big enough and if the rate's great, somebody might want to assume it. But I'd say the odds are 3 years from now that rates are going to be lower, not higher. So, that's the danger with these 10-year loans.
That's a really important point. I mean, you guys know those stats better than I, but every once in a while I see a stat that says for every 1,000 mortgages where people commit to for 5 years, 62% or 49% of these people are looking to exit before the 5 years is up, and of course they can pay huge penalties. So even worse here, because this mortgage being tossed into a pool and being securitized, there's no wiggle room, folks. You better be committed as you get into one of these transactions.
So, Barry, we've got 19 minutes left. We've got three kind of areas maybe to talk about that I can think of here that are from our notes. One is the tales from the trenches. We might want to do those last.
Okay.
The other is, a little about Neil and Garth in terms of what our value add is. We can do that anytime now. And then the last would be, how can we help investors dial in your property hunt, your search? How to know, particularly for newer investors or for those who are new to multifamily, how do you define what you're looking for? Where would you like to start with those?
I want to start with the value add, because I truly believe in the value add, folks. There's lawyers and of all different stripes. There's realtors of all different stripes. There are brokers of all different stripes, and so I am fully committed to Garth and Neil as the top flight guys who will tell you what's going on. It won't be any BS. They'll be nice, but they'll tell you exactly what you need to do. So huge value added here, but I'd like to hear the details of why you guys think you are what you are.
Well, in no particular order, Neil has CMHC correspondent status. That allows us to submit directly to CMHC, and it means that Neil is negotiating on your behalf with our interests aligned to maximize your position and get exceptions where they're achievable. And I've done this business without having a Neil and having to deal with a lender and have them deal with CMHC, and they're not going to use up a lot of their bullets on these smaller deals, especially that they save for the bigger deals in terms of asking for exceptions, et cetera, et cetera. The other thing I found was that lenders in those scenarios on purchases, they were charging a fee, where in the case where we're submitting to CMHC directly, there is no fee. You pay the broker fee, you don't pay a lender fee. So in terms of our interests being aligned, we'll get you the maximum loan to value. We'll get you the biggest mortgage that's achievable. We're paid a percentage of the mortgage amount. The more we get you, the more we get paid. We're aligned. Now, if you say, hey, I only want this much, that's fine. But there's only one client I can think of in the last few months who said that. We'll get you the lowest interest rate spread over bonds. That's a key one, because given that we will have the COI from CMHC due to Neil's direct submission, Neil then takes that to the market, and for whatever lenders there are available for the particular mortgage we have, smaller mortgages, smaller pool of lenders, larger is larger, but they're basically bidding for this deal, and it's a guarantee for them. It's a no risk loan because it's insured. And then, so I think the other thing is, we've both been at this for a long time. We've both been in business for a very long time. And we've learned that happy clients will come back for their next deal, and happy clients send other clients. And we don't spend any money on marketing, so that's where we have to build the business from. Neil, what have I missed?
No, you got it all.
So, folks, those are all important points. Direct access, best rates, time. I'm sure that direct access means quicker service, and it can be very laborious when you're having the lender contacting CMHC. So there's lots and lots of value here. So I strongly recommend that if you're thinking multi of any kind, talk to Neil and talk to Garth and talk to him quick.
But one thing with CMHC, they are like, whether it's a $1 million loan or a $10 million loan, everything's done by the order it's submitted. So
get it in quicker. It's going quicker.
Yeah. So they are but they're very fair that way.
Okay. Well, that's good.
They're also not as efficient as they used to be because they still allow everyone to work remotely.
Right. All right, Garth. So if we've got your value added proposition, I don't want to limit you if you think there's more.
No, that's good.
That's good.
We could talk really quickly about helping investors to set their criteria, helping investors determine what it is they should be looking for. Sometimes you get on a MLS drip, and you get emails saying, here's these properties and those properties, and we see investors really unsure of what is the right property for them. So they may be attracted by how how it looks, by the quality of the writing in the listing, by the pictures. Sure. But those are, not necessarily the key points. So think about discovering what you are able to qualify for. As Neil said earlier, we'll do an application. We'll come back to you and tell you what you're good for. Think about what's your ideal tenant demographic. Do you want to deal with blue collar renters? Do you want to deal with, I have a doctor client who built a new build under CMHC program a couple of years ago, and he understood nurses and technicians and hospitals. So he built a property near the New South Hospital in Calgary, and his tenants are all medical people. He understands them. They get on well. He manages it himself. That was a fit for him. So what's your fit? Think about your long-term objectives. What are you trying to achieve here? Are you looking to, do you want, as I say, your version of my life, or is it something else you're trying to achieve? What's your timeline? What's your timeline for the asset? What's your buying strategy? Do you want to buy and hold? Just buy something that's nice and run it and let it make you money and have the tenants pay the mortgage off? Or do you want to buy, improve, and then refinance, maybe into MLI Select, for example? Or do you want to buy and be a bit of a developer? Buy a piece of land and knock down a knockdown house on it and build an eightplex. What is it that you're trying to achieve? If you can detail all of that stuff, then if you need the help, we can help coach you into what that means, so that you can properly either instruct your realtor as to what you want by definition, including, what's the ROI or minimum cash flow that you require on the numbers side. And if you're doing your own hunting, then if you know your criteria and you know your numbers, you'll know what to look at. And you could look at 20 properties, and in 5 minutes on each one, you can sift out the ones that aren't worth the next step.
That's so important. I mean, I'm harkening back to earlier comments about, what kind of a property can you qualify for? People don't understand that having $200,000 down or $400 is not the end of their financial responsibility or commitment. And often, as you guys have experienced, people have a hazy vision. I mean, it's probably not even a vision. There's something hazy out there that's called multi that they've heard is good, and for some folks, they haven't got it, detailed any more than that. And I know it's not your job to tell people what they think or babysit them, but folks, if you can do some of this work on your own, following what Garth set out, then Garth and Neil can help you with, okay, so we need to flesh this out a little more, need to be a little clearer on this, and they can help you along. But the more work you can do in actually knowing who you are and where you're heading, the better this will be for you and the better they are able to help you.
So Barry, should we do Tales from the Financial Trenches?
Well, it depends. Are there questions, or should we do this?
Yeah, questions would be good too.
Let's see what else we have for some questions here. Assuming you want to increase the homes, how does one then build portfolios if you can only do 12 units at a time? Well, you can build large units if you don't have a high net worth because you are older. Whoa. Well.
Sorry, what's the question?
With CMHC wanting to increase the homes, how does one then build a portfolio if you only can do 12 units at a time? At what point can you build larger units if you don't have a high net worth because you're older? Well, you'd partner up with people, maybe form a corporation, find 1 or 2 or 3 other like-minded people, pool your resources, build something bigger. That's one way to go. I mean, there are others. And, groups like this are a great way for people to, lay out those challenges that they're facing and talk to one another. You'd be surprised. I'm continually surprised at how just sitting around a table with other like-minded folks solves problems or challenges for various people all along the way. Talk to others who are trying to achieve what you're trying to achieve and who are struggling with their own challenges. It's easy to see the solution to the other guy's problem. It's much harder to see the solution to your challenge.
Right. The blinders on. What's next? Mike McDevitt says, great info as always. Does CMHC consider property equity as a liquid equity when applying for construction financing for a new build?
Yes.
There you go. Next question.
But
okay, good timing, Neil.
Okay, but if you own the property by yourself, for sure. If you own the property with your spouse, or you own 75% of the property, yes. If you have a 25% interest in a property, which we see often, they'll look at it as part of your net worth, but it's not going to be of any use for when they look at your guarantee, because that property could never be realized on.
Yeah, what are they going to do with it? Can't get at your 25%. Okay, any more questions that we are missing? That's it. Okay.
All right.
Tales from the Financial Trenches.
I love this. But, we probably won't do it justice, Barry, because you just do such a good job with these. And I got to, for those of you listening, over the years, I've sent Barry my Tales from Trenches, thinking some of them might be useful to him. And 2 things I learned, they're not all useful to him. Some are. And I'm not a bad storyteller, really, but he tells the story so much better.
It's all
Anyways.
story.
What can happen, Neil, when you don't tell your broker everything?
All right. Well, okay. So I'll give an example of a situation that occurred earlier this year. It looked like a very straightforward transaction, refinance to pay out a VTB, which was at a very low rate of interest, which appeared, it was for 6 months, and this was almost a year after the person bought the property. But the information that was provided was that, it was no problem. It was just continuing on at this very low rate of interest, and there was no issue, and, it could be paid out any time at that low rate of interest. Anyway, when it came time to get a payout statement from the lender, who was the original vendor, it turned out that the rate was roughly quadruple what was represented. Payments hadn't been made in some time. There was a penalty clause, and the amount required to pay out the mortgage was about 15% higher than what was represented, and there wasn't room to go back and try and increase the mortgage amount, because the amount that we were going to get was basically all that the income was going to carry, and it was enough to pay legal fees and some other transaction fees. So that was a real problem, and the vendor was threatening foreclosure because they had run out of patience.
So the borrower should have said, it was due in 6 months, but you know what? We got trouble here. Should have told you. So what happened to that one, Neil?
Well, there was even more. There was actually an agreement between the vendor and the borrower, which detailed what happened after the 6 months.
Oh, no.
It just wasn't sent to us. Anyway, what happened? I mean, in the end, we got very heavily involved in negotiating with the vendor, and ended up coming up with a solution that worked for the borrower, and we were able to get the loan closed without him having to go to foreclosure.
Right.
But it was problematic, to say the least.
So you saved the deal. So folks, tell your broker everything. Full disclosure is always a good idea. It doesn't matter what. There will be news that shows up from what you disclose, but you may as well hear it first than hear it when it's discovered later to your chagrin. And tell you what, do that once to your broker. They're not very happy about taking other calls from you. They'll be at least very cautious about it, for sure.
That's a good point, Barry, because it puts the broker at some risk. It can put the broker at some risk. And that's very important for us to manage. But at the end of the day, the stress that is created by keeping things to yourself, and it can be for any number of reasons that you could look in hindsight and say, I would understand why he or she felt that way. They were embarrassed by this, or they didn't want that out there. They thought they could manage it. They didn't think it was going to be a problem, but they don't understand how all this works. So it would be, you could understand that, but the big warning is it can blow up your deal. It came very close to blowing this deal up.
Right. So that was one. I guess the other one,
what can happen where, let me phrase it, Neil. Sorry, let me phrase it as a question. What can happen when you ignore items that your building inspection requires to be done to your asset, and your insurance coverage is insufficient for CMHC or for the lender, and you don't know that ignoring these building inspection items is going to be a problem, and you don't realize that having done that you've got yourself a really good rate on insurance, but the reason is you're not covered for very much. Take it away, Neil.
So in this particular one, the borrowers bought property, and they got a 1-year mortgage, which needed to be refinanced. There were some issues with the original inspection, which were never dealt with. And when it came time to do the underwriting for this, there were a couple of issues. One was that the items that weren't dealt with got worse, not better, and the insurance company refused to insure the property any longer, so they had to go into a specialty policy, which more than tripled the insurance premium. So now the numbers didn't work. And even if the numbers would have worked, CMHC requires all perils insurance coverage. You can't have things excluded like flood or leaks or whatever. It's got to be everything. So the deal could never have closed until these items were repaired. And it wasn't a matter of money being held back on funding to deal with these. The loan amount was going to be significantly less. And in any event, insurance could not be provided to satisfy CMHC's requirements. So in this particular case, we couldn't do anything for them in the end, and they were left to deal with their original lender and try and get an extension until they could fix this.
So, folks, as you work your way through these things, you'll have a lot of information coming at you from high-level experts that are involved in your process. I mean, your broker like Garth and Neil, your quantity surveyor, your insurance agent. I mean, there's tons of people who have specialty interests in what you are doing, and they will try and tell you and try to help you, and they'll point out things, and that's why you hire them, and that's why they're good, is they tell you what's going on. So please ignore the coaching at your peril. My goodness.
Well, Barry, I can say, and all the time I've done this, the thing that's always the biggest problem, and it's always left to the end, is insurance.
Yes.
Mm-hmm.
Yes. And I mean, insurance has always been a problem, and recently with much tougher underwriting, it's a much bigger problem. And when you said the specialty insurer was 3 times what they might have paid, that original amount, the one times amount, is already like twice as much as it was 2 years ago. So insurance is tough, it's expensive, and yeah, we're always fighting with insurance at the end of deals. You're right.
Well, on that note, we've eaten up your hour, and just bang on. So Donna would be proud of us all, Barry.
Donna would be. Donna is watching us. I'm sure she's probably going to pop something in the chat. Well, guys, this is really good. Now, everybody listening, this is so many levels up from buying a local 3-bedroom bungalow and maybe putting a suite in the basement. This is quite a few levels up on the technical side of things, the complication side of things. There's lots going on, and so you need help from guys like Garth and Neil. So, guys, thanks for being on. Everybody, look at the other YouTube, especially from December 12th. Look at this one a few times as he collapses. It's consumption. I know. I'm pale. All right, gentlemen. Thank you very much for coming on. I'm pretty sure there's going to be more demand, and probably as we roll through another 6 months of the new MLI Select program, more things are going to come up. I'm sure we're going to have another session. Now, what about contacting you? Do we have your details in the chat? Does everybody know how to reach you? Don't want to leave without them knowing that. I
have no idea what's in there. Who's your tech person right now, Barry?
My tech person is Wayne Hillier. And so
Wayne, can you ensure that our what do they call it? Anyways, our contact info, phone and emails in the system here somewhere?
I can't. I mean, you guys are well, I can type it out really quickly for you guys here, or you guys can just say it, and I'll post it up here. So how about you just say it?
I'm Garth at mortgageconnection.ca.
Type.
And Shopsy at shaw.ca. SHOPSY.
Garth.
And the other one was what, sorry?
Shopsy, SHOPSY at shaw.ca.
Those are easy ones.
He's got a better
SHOPS. Oh, I messed it up.
SHOPSY.
Yep.
At shaw.ca.
Shopsy.
Now,
it's my nickname.
It's like you're a hockey player. They add, a Y to the end of everybody's name, and there you go. If you were playing for the Oilers tonight, Shopsy, get in the corner.
Hey, I used to hear that all the time, Barry. Except that would be
dang
louder.
it, Shopsy, why aren't you back checking?
Neil played some pretty good level hockey. Ask him someday to tell you about the various times he played with Daryl Sittler, who he knows quite well from a previous business.
Well,
all right.
Yeah,
next time I'm near to you, we're going to have a beer and talk about that. I would love to hear that story. Stories.
Many stories.
Sure, there's more than one. Yeah, for sure. All right, laddies. Thanks for everything. It's always a delight having you on. It's so full of information. It's I know quite a bit about this stuff, but I learn a ton every time we do it. So thanks again. We'll keep ourselves updated on what's going on with the program and other programs, and then figure out when you're going to pop on again, and we'll go at this one more time.
Good stuff. Thank you.
All right.
Thanks, Barry.
Good night, everybody.
As always.
Thanks a lot.
Night.
Okay.
Thanks, Wayne.
Good night, all.
Yeah. Night.